This is an update on the inflation outlook and highlights reasons number 9 and 10 to trust personal investment advice from our firm. Supply chain problems are cited as the main cause of rising prices, but those problems are expected to diminish by the end of the year. Price hikes on most goods are expected to end by the end of 2022, and prices on some goods may even be rolled back. For example, lumber prices at Home Depot soared in the spring of 2021, but reverted to pre-pandemic levels by early fall. The cycle on pandemic price hikes on goods is similarly expected to come to an end by the end of 2022. On services, the price hikes are unlikely to be rolled back because they have been caused by the need to pay higher wages, wage inflation. For instance, McDonald's CEO Chris Kempczinski, at a quarterly earnings call for investors, said on October 27th that prices on its menu in 2021 have been rising by 6%. He said the tight labor market is making it harder to keep restaurants open late, and wages at corporate-owned restaurants in 2021 are up by more than 15%. Why is there a labor shortage? The pandemic convinced many Americans to drop out of the labor force. The demographic bubble of the baby boomers means a large percentage of the U.S. population is age 65 or older, and they aged out of the labor force. Baby boomers who were in the labor force a few years ago have retired. Plus, many individuals 65 and older probably decided not to risk their health until the pandemic passed. In addition, many parents reportedly left the labor force to stay home with their children, while other Americans may have viewed the pandemic as an eye-opening event that made them reprioritize their goals in life and dial back on their financial goals. About 1.5 million more workers than expected retired. Between supply chain disruptions and a labor shortage, inflation is running higher than it's been in 3 decades, but it's not expected to get out of control. This chart is from Fritz Meyer, an independent economist whose data and analysis we license for client use in education programs. The solid red line shows the actual inflation rate, as measured by the Personal Consumption Expenditure Deflator, PCED. PCED is slightly different from the Consumer Price Index, which is the inflation benchmark most often referenced in the consumer press. The PCED is the inflation index referenced in Fed policy statements. The dotted red line shows the PCED excluding food and energy prices because of their volatility. But the most important data is over here in the gray lines. The gray lines represent the range of forecasts of the members of the Federal Open Market Committee, central bankers at the Fed who set U.S. interest rates. The FOMC consists of the 7 members of the Board of Governors of the Federal Reserve Bank and 5 of the 12 presidents of the regional Federal Reserve Banks. They all participate in the deliberations of the FOMC and submit individual economic projections in conjunction with 4 FOMC meetings a year. They're saying inflation will abruptly end in January 2022. This gray line represents the average low forecast of the panel, and this is the average forecast at the top of the range. Unless the FOMC members suddenly changed their minds in the past month, the Fed is predicting inflation will plunge to 2.2% in January 2022. Keep in mind, the members of the FOMC have changed their inflation forecasts considerably in recent months. Since their previous quarterly projection in June 2021, FOMC members hiked their inflation forecast for 2021 from 3.4 to 4.2%, nearly 25%. And the FOMC's 2021 inflation projection has been raised by 50% over its forecast in March. So the Fed's projections about the rise in the inflation rate have been considerably off base. However, the consensus forecast of 60 economic professionals surveyed quarterly by the Wall Street Journal agree with the 12 central bankers. The 60 economists surveyed in early October see a continued expansion over the 4 quarters just ahead. A 4.8% growth rate is forecasted by the journal's large panel of economic experts for the final quarter of 2021. That's lower than the 6% growth rate projected by this same group of economists just 3 months earlier. But the most important takeaway is that this large group of top economists are expecting much higher growth for not just the last quarter of 2021, but also for the next 3 quarters that will follow. These economists do not expect inflation to ruin the expansion. With above-average growth expected, the consensus projection is for a continuation of robust growth. The central bankers are saying supply chain problems will, for the most part, be resolved in the 12 months ahead, and the spike in wages is not the start of a wage inflation spiral that will be with us long term. Which brings us to reasons number 9 and 10 to trust financial advice from our firm. To deliver personal advice, we focus on the data that drive investment decisions, and we are committed to educating clients based on knowledge, data, and continued research on the most important financial economic facts affecting you and your family.